I can't think of a better person to kickstart our day. Please help me welcome John Cochrane.
Thanks for that very nice introduction. It really is a pleasure to be here. I want to kick off the conference by losing my glasses. I want to kick off the conference with an invitation to our job for the next couple of days to rethink the policy response to the financial crisis from the ground up. Now you say, why bother? Dodd-Frank is law. We should be working out, the mark-to-market rules for the interagency memo on the mark-to-market rules for swap dealers and clearing or something of the sort. No. You may say radical reform is not on the political agenda. Well, it will be. Left, right, and center, I think we agree on one thing, that the Dodd-Frank Act and the mountain of regulation that it sits on will not stop another crisis. Enshrined too big to fail rather than got rid of too big to fail, will shackle the financial industry and leave us with a sclerotic crony capitalist mess in its wake. And I think Elizabeth Warren to Rand Paul agree on this sort of thing. So we need to rethink from the beginning. Now, let's be sympathetic to Dodd and Frank. A crisis happened, finance failed, so we need more regulation. There wasn't much time for analysis. And they're not financial economists. They're politicians, which is a noble profession. And they and their staff emptied the shelves of the existing ideas and threw them into the soup, which is the natural thing to do. Our job is to restock that shelf with ideas that this time will work. So it's a useful enterprise. Let's go back and start by thinking about what the problem was. What happened? What happened when you boil it down to its essentials was we had a run. Remember Mary Poppins. Little Michael Banks wants his tuppence. The bank won't give him his tuppence. The lady hears that. She wants her money back. And next thing, everybody wants their money back. But they can't get their money back. Why not? As you remember the song, it's in railways in Africa, dams across the Nile, and other unpolitically correct investments. You can't all have your money back at the same time. And in fact, we had not just a run, we had a systemic run. Seeing a run on one bank, people start to question the next bank and run on that one too. Collectively, people ask for money that the financial system just does not have. And that's what happened to us. It was in the shadow banking system, not the regular banking system, but the mechanism was the same one that has been happening over and over again for centuries now. The run defines the event as a crisis. A run is what made the contagion. The best way to see this is the antithesis. What was not a run? When tech stocks fell in 2000, that was unfortunate, but it wasn't a run, it wasn't a crisis, and it did not kick off, it kicked off a very mild recession. Why? When your tech stocks plunge, what can you do about it? You go home, you might have a stiff drink, might kick the dog. What you cannot do about it is run to the company and demand your money back. And the company finds that it doesn't have the money to give you back and therefore send the money to bankruptcy. You can't do that. The institution that issues equity makes no promises and therefore can't go bankrupt, can't fail. When Bear Stearns and Lehman Brothers failed, they had portfolios of mortgage-backed securities that were leveraged 30-to-1 with overnight debt. That means every morning they had to find $29. They put in $1, they borrow $29, and then every morning they have to find 29 new dollars to pay off the 29 old dollars that they borrowed last night. No surprise that thing went belly up when people wouldn't roll over the loans. Now, what's wrong with that system? Are mortgage-backed securities so terrible? Not really. They're not that risky an asset. It's the 30-to-1 leverage with overnight debt that's the problem. So I think viewed that way, the fundamental answer is simple. We need to stop borrowing overnight. 30-to-1 leverage with overnight borrowing is not the way you fund anything. We need to more generally get rid of the run-prone securities that are used to finance investments by bank. Suppose that Bear or Lehman, instead of borrowing money overnight, had issued stock. They'll issue stock, they'll get the money for the stock and use that to buy their portfolios of mortgage-backed securities. The mortgage-backed securities go down 20%. They're illiquid, it's hard to sell. What happens? Well, the stock goes down 20%, and that's it. The investors go home and have a whiskey and kick the dog or whatever, but they can't run to get their money out. The business doesn't fail. the further lending from the business doesn't fail. It's not a crisis. So if we got rid of short-term funding and its cousins, then we could create a financial system that can have booms and busts, and will have booms and busts, but without having crises. And that's a nice limited goal. So how do we do that? Let me outline the sort of the core features of what we need to do. To have a financial system like that, first of all, if you as an institution want to offer a security like a bank account, like overnight repo, like a money market fund, something that promises a fixed dollar payment and first come, first serve gets their money in any significant quantity, you have to back that with treasuries or bank reserves. Then that cannot fail. What about investors who aren't happy with the rates of return from, say, money market funds invested in treasuries, who want to reach for some yield? That's fine, but they then must bear price risk. Any security, any company who is taking money and investing in something other than treasuries has to issue securities whose values float. They cannot make fixed value run-prone promises. Ideally for a bank, they just issue lots and lots of equity. That's fixed values that float. Equity can't cause the bank to fail. Things like money market funds, if you're invested in something other than treasuries, you have to have floating net asset values, ideally exchange traded, so that if you want your money out, you have to find somebody else who's going to buy the shares from you. Again, then you cannot have a run. The institution can't fail. We don't call the government to bail us out when things get into trouble. Now, banks might want to make risky investments, like lend you and me money. How do they do that? They issue equity, or they get in the business of originating to sell and then bundling securitized debt into floating value securities. A financial system where you or I borrow money for our houses, those are put into mortgage-backed securities. The mortgage-backed securities are held in floating value funds that go into our pension funds. That's a very safe financial system. There's nothing wrong with securitized debt, because nowhere along the line is anybody making a promise that you can run and get your money back and therefore drive it into bankruptcy. Now, objections. You say, wait a minute, where are we going to, this is going to starve the economy of credit. If banks can't issue something like deposits, if we can't have overnight repo financing and so forth, where will all the money come for investment? But the central fact of finance is that no extra money is needed to do this. There's the old Casey Stengel joke that says that, how many slices you want your pizza cut up in? He says, oh, only cut it in 12. I'm not that hungry today. We are simply slicing the pizza into different slices. Banks have assets. You're in my loans. They have liabilities, deposits, and equity. The risk of the portfolio of liabilities is the risk of the assets. We're just carving it up in different ways. If banks issue lots and lots of equity and much less debt, the riskiness of that total pool of assets is the same. The same amount of money is needed. The same amount of risk must be held. It's just carved up in a slightly different way that doesn't have that poison in the well of run-prone debt. If you really, really need bank debt, let's do it this way. The bank issues 100% equity. Floating value cannot fail. Equity financed institution cannot go bankrupt. It's never made a promise that you can be hauled to bankruptcy court. Then take that equity, put it in a downstream vehicle that takes the equity, carves it into equity and debt shares. Now we've got the same thing. We've got bank debt, we've got leveraged bank equity, but that thing we can fail in 5 minutes. It's not even thinking about to think of an entity that holds bank stock as its assets. It's issued equity and debt, and the bank stock goes down in value, can't pay off its debts. How long it would take the lawyers in this room 5 minutes to fail that institution. It's not too big to fail. There's no complex web of claims to go to bankruptcy court. Done, and no taxpayers need to get involved. Now, we have been here before. In the 19th century, our money was coins, and then banknotes were invented. And banknotes are much better than coins. So the way the 19th century used to work, banks would issue paper money and use that to make loans. And the paper money was very useful. If you're running a business, hauling around coins is really a pain. So the paper money is much lighter than the coins. It's useful. But as you can imagine, or remember, if you're almost as old as I am, That system had its crashes. If banks are issuing paper money, every now and then they've issued more money than they have assets to pay for. We have runs, we have crashes. What do we do about that? Well, towards the end of the 19th century, the US said, look, our government has a natural monopoly. It can issue paper money that won't fail, that works a lot better than this bank money. And what the financial industry screamed, oh, wait, that'll be a disaster. If we can't issue money, no, we'll never be able to finance investment anymore. We'll never make any loans anymore. Growth will come to a standstill. Well, that one turned out all right, didn't it? The government took over its natural monopoly in issuing paper money. Well, where are we now? In the last 20 years, we have invented interest-paying money. It's a wonderful thing. Your money market funds, your short-term government debt, overnight repo, we can now hold lots of money, very liquid assets, without losing the interest payment. And that's what our financial system has done. But like the 19th century, the private interest-paying money that we've invented is prone to runs and crashes. What I'm basically saying is we need to do the same thing for our interest-paying money that we did in the 19th century for our notes. The government has a natural monopoly. Reserves that pay interest, short-term treasuries are great stuff, actually. I'm sorry for a Keynote conference to have to say the government does something well, but it does. And it did. Paper money is a fine thing, except for the little problem of inflation, which is a problem for another day. And basically, that's what I'm proposing. Do the same thing for our interest-paying money that we did before. The banks are screaming, as they did before, and that screaming is just as empty. We will be able to finance investment with floating value liabilities as easily as we did with fixed value ones. Now, I do have to give a little Mercatus Cato libertarian apology here. I am basing my vision here on government-provided money, on interest-paying government debt. That is our money today. Short-term government debt is our money and will be our money, at least unless we have a great global sovereign debt crisis, which is a topic for another day. It's fun to think about Bitcoin or gold or stuff like that. It's not happening in the short run. And there's a danger of overreach. You don't have to supplant government money in order to solve banking crises. So let's talk about how to solve banking crises without doing that, and leave that for the beer for afterwards. Now let's talk about the current path. That's not where we are. And where we are, let's try to understand it. It's not from silliness. Where we are is a natural progression. The little old lady swallowed a fly. And then she swallowed a spider to catch the fly. And then she swallowed a bird to catch the spider. That's what happened to financial regulation in the US. In the 1930s, we had big bank failures. And what did we do about it? Well, you can stop runs with deposit insurance. If the depositors have their debts insured by the government, then they won't run to get their money out because they know they don't have to be first. Good. But you guarantee deposits and you engender moral hazard. Banks, now that the deposits are guaranteed by the government, have an incentive to take on too much risk. Depositors, now that the deposits are guaranteed by the government, don't care if the banks are taking on too much risk. So the natural market forces that would police the safety of bank assets are gone. So what do? Well, we'll put an army of regulators in. And the regulators will keep the banks from taking on risks that before the banks themselves didn't want to take on, and their investors insisted that they do not take on. Well, you know what happened then. The banks cleverly got their way around the regulations, and we had another failure. The government guaranteed more debts and added more regulation. The banks worked their way around the regulations, and we had another failure. The government guaranteed more debts and added on more regulation. Continental Illinois, the savings and loan crisis, the Latin American crisis, the Asian crisis, long-term capital management, and of course Bear Stearns, which when it was bailed out, that was the one that, bailing out always stops a crisis, right? The Dodd-Frank Act and its regulation is not a fundamentally new, dangerous idea. It's just a natural extension of these ideas that were sitting on the shelf. But ladies and gentlemen, horse is on the menu. Are we really going to eat it? Because it's astounding how far it has extended this set of ideas. Essentially, all debt is now government guaranteed, and essentially all of finance is under detailed government control. The FSOC is now seriously about to regulate equity asset managers like BlackRock and Vanguard. Now this is the paradigm of a non-systemically dangerous institution. They take your money and they invest it, But it's clear what they're invested in, and the promise is floating value. You cannot run to get your money back. They ought to get gold stars for creating non-systemically dangerous institutions. And yet, what's going on? I'm reading from the Treasury report. Well, some portfolio managers might reach for yield. Asset managers might crowd or herd into popular asset classes. These behaviors could contribute to asset price volatilities. Investors might not recognize the nature of risks taken by their portfolio managers. I mean, can you imagine what the founding fathers are thinking, that the job of the federal government is to protect us from this sort of thing? And the new tools, too. So we'll talk about macroprudential policy, but think about what that means. Macroprudential policy means the Fed is going to diagnose and target bubbles and support asset prices in a crash. Basically, we're now not just going to regulate the banks. We're going to try to keep market prices from falling so the banks never lose money in the first place. And the size of the guarantees is tremendous. If you think, last one was big, the next one's going to be bigger. Now, what's the difference between the vision I've expounded and where we are now? The current regulation focuses on bank assets. We'll keep them from buying risky stuff, and then we'll manage the prices of the assets in the market so they don't lose money in the first place. I focused on liabilities. It's the promises they make. It's how banks get the money that is the poison in the well, not really what they do with it. If the liabilities can't run, if the banks have equity or floating value liabilities, it doesn't really matter what their assets are. And there's a huge paradox out there. Bank assets are not that risky. We've made fun of mortgage-backed securities and stuff, but portfolios of mortgage-backed securities on the level of asset markets are just not particularly risky. They're basically debt. Compare them to the assets of any company, a car company, a tech company, even Apple or Google. The riskiness of the assets of any company is just orders of magnitude bigger than mortgage-backed securities or loans. So why are we investing all of this effort into taking care of the risk of the safest kind of assets that exist in the financial system? Because they're leveraged to the hilt on the liability side. If they were funded by equity, we wouldn't have to worry about it at all. And that's lovely. We want to limit what we have to do. If we could fix the run-prone liabilities, we wouldn't have to bother with all the asset management. I allow competition, innovation, rule-based regulation, not regulatory discretion. That's where we are. In order to regulate the assets, we have to stop competition among the banks, and we send this army of regulators out to sort of approve every deal. Most importantly, the view I have sketched has a limitation to it. We're only going to try to stop bank crises. We don't have to solve all the other problems there might be or you might imagine to be in the financial system. The current idea of regulation is, let me try to pick some from the left and the right. Why did we have a crisis? Well, there was a housing bubble and Fannie and Freddie and the Community Reinvestment Act and savings glut and global imbalances and on and on and on. Or there was greed on Wall Street. All the problems of the world seem that we need to address in order to solve this problem. Well, no. Whether those are problems or not, whether it might be good or not to fix them, I'd love to fix Fannie and Freddie. If we could cure run-prone liabilities, we would not have to cure all that other stuff, real or imagined, in order to not have financial crises. Limit what you're trying to do, and then there is some small chance of success. The Dodd-Frank Act, interestingly, it never defined what systemic is. I've defined what systemic is. A systemic is runs, and once we stop it, we're done. The problem with not defining systemic is that there's no definition of what it isn't. There's no safe harbor. If you want to say, look, I'm a patriotic American, I want to start a financial business that doesn't endanger the financial system, what's the rule book? Well, how can I set this business up? It's not there. There's no way you can set up a financial business and say, look, I'm now exempt from supervision and designation and so forth. Exchange-traded funds, which I would think of as the number one. Well, no, apparently they might be in trouble too. Most of all, my vision focuses on contracts. There's a genuine problem with making fixed value, short-term promises. It's an externality in economic language. So let's cure the contracts, the behaviors of institutions. Under current regulation, institutions are named. You are designated as systemically important. Your person, your institution is systemically important, not based on what behavior you've done. So let me offer some hope. This seems like big difference. We're going to focus on bank liabilities. We're going to have banks and financial institutions fund themselves by floating value promises, not by short-term debt. And then we can get rid of a lot of the other stuff. Boy, this seems like a big change, doesn't it? But no, there is some hope. I've watched the slow march of ideas over the last 4 or 5 years, and it's been interesting to see how these ideas are improving. When the Dodd-Frank Act was passed, there's a little bit about, oh yeah, bank capital, right? We need some more capital in there, along with 1,000 other things. As regulators, as the Fed, as everyone has thought about this, the idea that, oh, maybe we could make banks hold 2 or 3% capital, would that be terrible 5 years ago? Now people are saying, oh yeah, 10%, 20%, 30%, I don't see any big problem with that. The system has slowly digested the Modigliani-Miller theorem, which tells you that more capital is actually a much better way to regulate than the detailed micro-regulation that we're heading to. I want to say something nice about the Federal Reserve. The policy of paying interest on reserves and keeping a large balance sheet and now opening interest-paying reserves to private borrowers is excellent. This is the step towards providing easy, cheap government interest-paying money, just as you and I all use easy, cheap, government-provided non-interest paying money. I even have some, unusually, This stuff is great. and the Fed's policies of interest on reserves and a large balance sheet begin to crowd out the overnight repo and the privately provided stuff that crashed. So we can move to a sensible system, even with, we do not have to repeal Dodd-Frank and start from scratch. The harder part will be to let the rest of Dodd-Frank die on the vine. Intensive regulation, intensive discretionary regulation, the invitation to macro-prudential bubble pricking and so forth. This is very useful for stopping competition. It's very useful for the revolving door from Wall Street to Washington. It's very useful for those in Washington to get the big banks to be politically pliable in return for protection from competition. It's very useful for those large the parts of the Fed and the IMF and so forth that want to be important and direct investment to various places and to diagnose gluts and imbalances and so forth. So getting the rest of it to die on the vine will be harder. But I do have some hope here, and underlying it is modern technology. What I've sketched is sort of a view of narrow banking, and the fact is that modern technology allows us to have the kind of narrow banking we've been talking about for 400 years, but technology really didn't allow it to be there. And we can eliminate the 400-year-old scourge of debt crises and bank debts if we move to a financial system where highly liquid, floating value assets are the main part of the liabilities that then go fund to investments. We can have booms and busts without crises. But, asterisk, what I've talked about is how you solve banking crises, how you solve private crises and crashes in the context of a solvent government. There's a separate kind of crisis, which is a sovereign debt crisis. That's a different talk. It's a different mechanism. Setting up a financial system to be immune to a sovereign debt crisis is something we should be thinking about, and we're not. We will probably only do that after a sovereign debt crisis, but let's hope that we pay our bills off rather than have to face that one anytime soon. In closing, everybody is always trying to sell you something. I'm an academic. I sell my papers. My comments today are based on a paper I've written called Toward a Run-Free Financial System, and if you Google that or me, you will find it along with all sorts of other things. So with that, maybe I should take some questions, and I love objections. Or did I just end that one so quickly?
No, we have time for one or two questions. If you want to approach the microphone and say your name and affiliation for a question for John. I told you he's not too grumpy. The ideas are improving, so that's good news. Sir?
Yeah, question. Is this on? My name is Bert Ely, a banking consultant here in Washington. Just a question for you with regard to the type of banking system you envision. What would you allow financial institutions or some kind of financial intermediary to issue fixed claim liabilities to those individuals and businesses who, for whatever reason, rational or irrational, would like to have assets that have a fixed dollar value because, for whatever reason, they don't want to hold assets that have a floating value.
If you want to hold fixed value, short term, come and get it anytime you want assets, those have to be, in my vision, in any large quantity, those have to be backed by treasuries. Now, fortunately, a fortunate side effect of our recent fiscal profligacy, there's $18 trillion of treasury debt out there, and that can back any conceivable demand for fixed value, run-prone assets.
But what about longer term fixed value financial assets, such as 5-year CDs or something the equivalent?
Yeah, now long-term debts, that occupies sort of an intermediate place between short-term debt and equity. The real poison in the well is short-term run-prone debt. Long-term debt has this advantage. Suppose we have a bank, we've issued 5-year CDs, we've invested in mortgages, those tank. Now the CD holders, they're going to be paid out in 5 years. They can't come tomorrow morning and say, pay me now or else. Now, it's not like equity where they can never come and say, pay me out, but we've got to solve this problem within 5 years. So that's much less dangerous than this very short-term debt. And what I would do is, there's a nice sliding scale. I think the right way is not quantity regulation, it's a tax. You want to issue short-term debt, you're going to pay 5 cents on the dollar. Long-term debt, we'll say maybe 2 cents on the dollar. Issue equity, that's free. Let's stop subsidizing debt, and then if needed, let's tax it, and we tax it more for short-term run-prone debt.